Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into a post-pandemic world, risk management continues to be a top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website within a day. Today's presenter joined LLIS in 2005 and has paved her way to covering various types of disability and critical illness insurance. You can count on her to bring you the most up-to-date solutions and stats in the disability insurance industry. Here to present on how to replace lost income if disabled is Kathy Bilodeau.
Thanks, Claudia, and thank all of you for joining this afternoon. My hope is that you will have the tools to discuss disability insurance more confidently with your clients. Keep in mind, we're always here to assist you if you think like you're navigating some rough waters and don't know what's the right choices. Give us a call and we'll help you through it. So some of you might be asking, what is disability insurance? Okay, sorry, had to be in the right spot to get this going. So what is disability insurance? Perhaps some of you have seen this presentation of the pyramid in the past. What this is simply telling you that your client's income is the very foundation for not only for them to pay for their mortgage or their rent or their groceries, car loan, childcare, etc., but it also pays for all that other protection, such as their auto insurance, their life insurance, their health insurance, their property insurance, homeowners insurance, and also it allows them to put money away for retirement and any other savings that they want for maybe passing down to beneficiaries after they pass away. So doesn't it make sense to insure that income if it's that important to insure their life, their auto, their health insurance? So what does disability insurance do? Plain and simple. Disability insurance provides monthly payments to help with your client's daily life expenses in the event they become too sick or too hurt to work. And it's more likely that they'll be sick because there are more disability claims for sickness than there are for injury. So why the need for disability insurance? I put some statistics together because this is Disability Awareness Month, and I thought I would share these with you. First of all, 3 out of 10 Americans can't pay an unexpected $400 bill without using a credit card or borrowing from family or friends. In addition, in 2019, 1.3% of Americans missed work due to an occupational illness or injury. And did you know that the average Social Security disability benefit as of February of this year was $13.59 a month or $16,300 annually? How many of your clients can live on $16,000 a year? And oh, by the way, wait 3 years to hopefully get your Social Security disability claim approved? And lastly, in 2019, bankruptcy filings cited 77% were due to a loss of income, and of that 77%, 44 cited medically related work issues. So in other words, they were probably disabled. So the who needs disability insurance? Well, anyone who's earning an income and relies on that income to pay their bills and doesn't have some other alternative stream of income like rental property or trust income or something else that's going to continue to flow to them whether they're able to work or not to help pay their bills. And just so you know, according to the American Payroll Association, nearly 69% of individuals in the pre-pandemic America reported that they would experience financial hardship if their paychecks were delayed by just 1 week. So, what are the 3 most common objections to disability insurance? The first one is, do I really need it? It costs way too much. I've got something through work. We don't need to talk about that. Well, each one of these objections are going to be answered throughout the presentation. And this is going to help you when you sit down with your clients. So, there's 4 things to know about disability insurance. The first one is, how much can I get? And that's what is known as the disability benefit. The disability-based benefit is the monthly amount that in the event your client is disabled, they will receive on a monthly basis to help pay their bills. When does it start? Well, that's what is known as the elimination period. In the elimination period, there are several options. These are all days, 30 days up to 365 days. Now, the sooner the elimination period, i.e. 30 days versus 365 days, the more expensive the premium is going to be. So there's different ways in order to customize the policy, and we can do that using the elimination period. How long does it last? This is what is known as the benefit period, and we have all kinds of different benefit periods, as small as 2 years up to age 65, age 67, and with some policies we can actually go to age 70 now. So the reason for the different benefit periods can be because of the nature of someone's occupation. So if someone has a more physical or manual labor type occupation, they're probably not going to be eligible for an age 65 or an age 67 because they're more likely to go out on claim if they physically can't do their job. In addition, sometimes the underwriter will use a smaller benefit period if there's a medical condition that they're really not ready to go out on a limb for, if you will, to age 65. So they can say, hey, we're willing to give them coverage, but we're just not going to go to age 65. We're more comfortable with maybe a 5-year or a 10-year benefit period. The good news about these smaller benefit periods, the 2, the 5, and the 10, is they do reset themselves. So in other words, if someone gets a 5-year benefit period, they go out on claim for a heart attack, and they're out for 2 years, and they go back to work, and a year later they have a stroke, they have a whole nother 5 years of disability benefit because it's a different diagnosis. And the last one is, how much does it cost, or what we would call the premium. And the premium is what is encompassing all the different features of the policy. And what it also does is it allows a client to kind of customize the plan for whatever premium they can afford. And just to kind of give you a heads up, men pay less for disability insurance than women do. On average, women will pay about 78% more when they're in their 20s to their mid-40s. And that's simply because there's so many different pregnancy/maternity claims. So the information that we need to quote a disability insurance policy is several things, and I'm just going to kind of touch on these little by little. So the first one is the client's name, date of birth, what's their gender, what's their state of residence, do they use nicotine in any form, what's their income. In income, we need their base income, if they have a bonus, if they have commissions, if they have stock. We need all that broken down. In addition to that, occupation. So with occupation, we're going to dive deeper into this in just a few slides, but the last one is, do they have any other coverage? So do they have an individual disability policy already, or do they have group coverage through their employer? And if they do, who's paying for it? Is the employee paying for it, or is the employer paying for it? So disability insurance underwriting is broken down into 3 tiers. So we're going to be going into each one of these tiers, the first one being occupation, medical, and financial. So let's start with occupation. So these are some questions that perhaps if you could kind of talk to your client about, if you're going to be requesting disability quotes, because this is kind of the information that we need in order to assess how to quote them. So it helps us sort of classify their occupation. And the first one is, does your client perform manual duties? So depending upon whether they're physically doing something, a plumber, electrician, carpenter, baggage handler, versus someone who's sitting up at a desk. Also, what's their environment? Kind of like the first one. Are they working in an office environment? Are they working in an airport? Are they going to people's homes? What exactly is the nature of their job on a day-to-day basis? Are they a W-2 employee, or do they have ownership? Are they self-employed? What is their nature of the business in terms of, is it a self-employed, one-on-one, no other employees? Do they have 1099 contractors? How long have they been in business? All that kind of stuff comes into play. Do they have multiple occupations? So if you have someone who is an office worker, but on the side coaches basketball, that's going to come into play, because obviously there's a little bit more risk if someone's coaching basketball than sitting at a desk. And lastly, how many hours do they work? We try to see if they work full time, which is roughly about 30 hours a week with most of our carriers. And then with regard to the classification, these help to, I'm sorry, just went over. This sort of goes into a little deeper detail than the first slide with regard to the duties. Environment and travel. So when an underwriter sees that someone travels more than 25% of the time, that's not a negative. What it is it's a situation where if that person's duties require them to travel, meaning get on a plane, get on a train, and they're not able to do that, they're going to be considered disabled, versus someone who works from home and can still work because they don't need to get into a car or get on a plane and drive. They're also going to be looking at income. How steady, how stable is it? They don't like to see ups and downs. They like to see kind of a steady income. Stability and education. So someone who's job hopping, that's a bit of a concern. And education. Someone who has pursued, being a surgeon, obviously is very serious about that, because there's 12 years of education involved in that. So they're much more likely to obviously want to perform those duties and not sit home on a disability claim. And then also sort of like what we talked about before with multiple occupations, they're going to want to see what's involved in all the occupations in terms of their duties. So here's a slide that sort of explains the occupation classes. So the first thing to remember is the higher the occupation class, the lower the premium. When we have the A, and we actually have a B as well, this tells us that those duties are going to be at a higher risk. So they're going to probably pay a higher premium. And as you go down the line, you can kind of take a look and see these are less physically demanding. So the premium is going to be lower, in these types of environments. So let's look at a case study. This is David, and he's a 4A occupation class because of his income. And what we did here is just sort of illustrate what the premiums are going to look like if we have an identical situation between a male and a female. So this is David with $5,000 a monthly benefit, no other riders, just straight base. He's 35 years old. He's a 4A, and his premium is $1,440. But if you look at Daniela, exact same age, same benefits, but look at the difference in the premium. There's like a 78% difference when a female is applying for the exact same disability. And like I said, it doesn't start to level off a little bit until like their mid-40s, because in the eyes of the insurance company, they're probably not going to be having children beyond age 45. And I wanted to point this out because sometimes we'll have couples that are applying for disability and requesting quotes, and they're like, why is the female so expensive? This is why. So we talked about all the different types of occupations there are and how underwriters take a look at them and kind of assess the risk associated with them. But within a disability policy, they have a definition that's associated with an occupation that has to do with the actual protection that that client will have in the event that they become disabled. So I'm going to go with the top one, which is any occupation, transitional occupation, modified own occupation, and own occupation. And we're going to break these down little by little so that you can get an idea of what these are in case you're doing a policy review of one of your clients and you're trying to figure out what exactly that definition means. So the first one is the any occupation. This is what you'll see predominantly in a group policy where they want to get you back to work in some sort of occupation. And so what they'll do is they'll review your client's skill set in education and physical ability. And if they're able to do some other job other than their own occupation, they'll be asked to do it. The next one is called transitional. And what this one says is if the client, by again, their education and skill set, they can transition into a new occupation, they'll still be able to collect some or maybe all of the benefit from their disability policy to make up for the shortfall in their income because they're not making the same amount of money as they were in their original occupation. So for instance, let's say someone is a doctor and they transition into being a teacher, a professor at a university, teaching medical information. They obviously are not going to be making the same amount of money, but transitional kind of gives them a pat on the back and says, hey, we appreciate you going out and doing something rather than collecting a full disability benefit. The next one is modified ONOC, and what this one says is the client can receive benefits as long as they're not working in any other occupation and they're totally disabled. If they go to work in any other occupation, then they're going to have their benefits cease. And then the last one, own occupation, or what we call here ONOC, this is the one that is the most comprehensive, the most sought after. And this one essentially says that if the client cannot do the substantial and material duties of their occupation, and they choose to, they don't have to, but they choose to work in another occupation, they can collect 100% of the income from that new occupation, plus 100% of the disability benefits from their policy. And traditionally, we'll see definitely doctors that are surgeons and specialize, dentists, attorneys, they want that specific ONOC definition in their policies. So we talked about the occupational portion of underwriting. So now we're going to switch gears and we're going to talk about the medical aspects. These are some of the aspects of medical underwriting that may or may not be required. So with this, the first one is the tele-app interview. And this is definitely something that happens with most of our clients. And it's a telephone interview by the insurance company to kind of go over the application to make sure that they have a better understanding of the client's health, their habits, medications, anything like that. Paramedical exam, most of the carriers that we're working with since pandemic are not requiring a paramedical exam unless you're applying for $10,000 or more of benefit. When a paramedical exam is required, that means a nurse will come to the client's home. They're going to take their height, their weight, their pulse, their blood pressure. That's what those physical measurements are. In rare instances, an EKG might be required. And they're going to ask them some some medical questions. The last one is the attending physician statement. So behind the scenes, what insurance companies have the right to do is to run your client's name through something called the MIB, which is the Medical Information Bureau. And they can also run their name through the motor vehicle report. They can run their name through a prescription database to make sure they disclosed any medications they've been taking. In addition to that, they can run their name through a claims database. So if their health insurance company is paying for some sort of health condition, they want to make sure they disclosed it. And then lastly, they have the right to request medical records. And this is all information that they use to help to make a decision on to approve someone. So this is one I wanted to point out because we get a lot of questions, not only from advisors, but from clients about claims. And number one that we get is right here at the bottom, 9% mental health disorders, substance abuse. Traditionally, it's more the mental health, anxiety, depression, attention deficit disorder, bipolar, or ADHD. Any of those fall under the category of mental health. So if someone's actively being treated, either through talk therapy, medication, that is probably going to require an exclusion. We're going to talk about that a little later on. But the number one claim for disability is musculoskeletal, or what we call back spine issues. And that's because it can't be proved or disproved. Lots of times people will say they're suffering from chronic back pain, and it's can't be disproved. You know, even though they've run every test under the sun on the person can still complain about chronic back pain. But you can take a look at this, see some of the other ones. Injuries is 12%, nervous system, circulatory, cancer. So with the injuries, that's why I said most of the claims are health related and not injury related. So these are some concerns that underwriters will have when they're looking at someone's application. If they've got any of these pre-existing conditions, they can come into play in terms of maybe modifying the offer that was originally applied for. So these are some possibilities where a medical condition could be discovered where the underwriter can still possibly give them an offer. So you've got diabetes, talking about the back strain, carpal tunnel, Crohn's, build, colitis, things like that. These are ones where they do try to make an offer. It just may not be with all the bells and whistles that we originally applied for. Here's a list of what we call our automatic declines. And these are ones where, beyond a shadow of a doubt, they're just not going to take it on. And some of these are autoimmune disorders, and so there is no end to those. They can lie dormant for a while, and then someone could have a flare, and then that flare just goes on and on and on and on. So that's why they're somewhat reluctant about taking on any of these. Now, with the arthritis, which isn't on here, that is one where this one is rheumatoid arthritis, but just general arthritis, that's one where they'll take a look at it and see how many joints are affected, and they could possibly get an offer for just general arthritis. So when there is some sort of medical issue, what the underwriter tries to do is present some sort of offer by modifying the original application. And the way they do that is they'll look at the first one, which is reduce the benefit amount. So there's a lot of moving parts with disability, and I know that can be overwhelming for a lot of you, but it's also a blessing because it allows us to, and the underwriter, to tweak the policies so that we're able to give them something as opposed to just saying, no, we're going to have to decline them. So some of the moving parts that they can manipulate are the benefit amount. So in a couple of situations, if someone's financials did not allow them to qualify for the original amount, then they're going to reduce the benefit amount. But from a medical standpoint, it might just be a situation where they're not comfortable doing the $10,000 that you applied for. They may say, you know what, we're willing to do $7,500, but we're not going to do the $10,000. So that's a way where they can still offer something. The benefit period, we talked about that. With regard to certain occupations, they're not allowed to get a very long benefit period. With medical, this is a way for someone to say, hey, we know that they've got this Crohn's and we want to be able to give them something, but we're not going to give them at age 65. We'll give them a 5-year benefit period. And it just sort of reduces the exposure and the risk. Lengthen the elimination period. This is something that they'll do like if you have like a back issue. So, let's say someone has some back issues, not real serious. They don't want to give a full exclusion and not cover it. So they might come back and say, hey, you got a back issue. We're willing to cover it, but we're not going to cover it until 180 days or 360 days have elapsed. So there's ways for them to do that. The last one is modify or eliminate optional benefit riders. So in certain cases, if you want that own occupation rider, but they're only going to give you a 5-year benefit period, you lose the ONOC. So in other words, some insurance companies say, we're not going to give you ONOC if you have a 5-year benefit period, only if you have a 10 or age 65. So they've got some little quirks that they'll work around, but the vast majority of the time, if you get any kind of offer, we encourage the client to take it. So again, underwriting actions, rate the policy. This is one where they'll be asked to pay a higher premium. So, and again, someone that has Crohn's, they may get a 5-year benefit period, but they may be asked to pay a 25 or 50% rating just to help cover the possibility of them going out on claim for that. And then an exclusion would be for someone like mental nervous. If they're actively taking medication, going through treatment, this is a situation where they'll put a mental nervous exclusion on the claim. If they go out on a disability for mental nervous, there are no claim benefits going to be paid. But if they go out on claim for something else, it's going to be paid for. So it gives them coverage. It just reduces it in certain medical areas. So there is a reconsideration period when they do a modification, and the reconsideration period is usually given to us by the underwriter. And this is a great thing, because what happens is we tell the client at the time of offer that the underwriter is willing to reconsider the removal of this rating, the removal of this exclusion, the possibility of increasing the benefit period, whatever the restriction was. We will tell the client, this is what you need to do. You need to go treatment-free for 2 years, or you need to be done with physical therapy. Whatever it is, we're going to be very specific so they know what they need to do in order to enhance or improve their existing policy. Now, this doesn't mean that it's automatically going to happen. In order to help facilitate this, we have what is known as a circle back here at LLIS, and it's a free service that we provide. The client doesn't need to remember. The advisor doesn't need to remember. We have someone that we feel that this is so important that's dedicated to doing this. And we will put a circle back in the whatever time frame the underwriter indicates, and circle back to the client and ask them, hey, are you done with the physical therapy? Hey, are you done with the treatment for whatever it was? And if they are, we will ask them if they want to pursue getting their policy enhanced and help them fill out the paperwork. And then we track the paperwork and then send them the new endorsement pages. So that's something that, like I said, LLIS will help the client with. So the last thing about medical underwriting I want to talk about is marijuana and COVID. And of course, marijuana was always the topic until COVID came along. But right now, these are the two underwriting issues that are kind of changing, but this is pretty much up to date. So if any of your clients are using marijuana, we try to find out, are they using it recreationally or are they using it medicinally? Because obviously this is a state insurance issue. So whenever we're asked about this, we need to make sure that, even though their state might think it's okay and legal, the insurance company might feel differently. So it's all about the frequency. So we always ask, how often are you doing it? And if it's once a week or less, they can be considered for non-tobacco rates. But if it's more than once a week, then it's going to be tobacco rates or a decline, depending upon how much it is. With disability insurance, tobacco rates can be 25 or 30% more than the standard normal rate, which is great, because with life insurance, the rates can be 200 to 250% more if they're considered an excessive weed smoker. With COVID, it's 30 days if they weren't hospitalized. So if they had mild symptoms, weren't hospitalized, have been treatment-free for the last 30 days, we can go ahead and submit an application to underwriting. Okay, so now we're going to switch gears and we're going to talk about the exciting one, financial underwriting. So most of the time, underwriters want to see 1 to 2 years of tax returns with regard to financial. And the reason for that is they're looking for consistency. Sometimes there could be an anomaly. Someone got a great bonus because it was a great year, but that's really not the norm. So that's why the look back period is 1 to 2 years, particularly because of bonus, commissions, stock options. There are opportunities for us to use stock that was exercised, shows up on the W-2 as earned income. So those are all things that they're going to be looking at to make sure it's been consistent. With stock, the look back period is 3 years and they average it. They'll also look at pay stubs depending upon where we are underwriting the person. It might be a year-to-date pay stub because we're looking at November, December. If we're in January, February, we might be looking at a W-2. So it's just going to depend upon where we are in the calendar year as to what's appropriate. With contracts, this is really important when we have our self-employed individuals. The reason for that is because if they're newly self-employed, it's important to show that they've got contracts, that there's going to be a revenue stream coming in, so the underwriter has a good idea about whether they're going to be successful or not. So this slide explains the types of income. So the first column, we have earned income, and that's, like I said, that's your W-2 income. That could be, self-employed income, anything that's earned income, including, like I said, restricted stock units that have been exercised on a W-2 can be considered earned income. And on the unearned income, this is things such as net rental property, trust income, royalties, anything that's going to continue to flow to the client, whether they're disabled or not, and they can use to pay their bills. Now, if unearned income is greater than 10% or $30,000 a year, the underwriters do reserve the right to reduce the monthly benefit that's been applied for. Net worth, if it's anywhere between 6 to 10 million, we could possibly get them coverage. If it's over 10 million, they're not going to be eligible for coverage. So earning patterns, this is something that's important for you to kind of take into consideration. When we're looking for a benefit amount, I mean, obviously we try to give them the very best that we can, but we're looking to see if their income showed a decrease. And obviously, with the pandemic, that's been all over the place. So we try to paint the best picture, but realistic to the underwriter. If the income shows a significant increase from one year to the next, again, they're going to look at a 3-year average. So we want to paint a picture that is legitimate so that the underwriter has an idea as to what the future might look like for this client. So with financial, they're looking at income and also occupation changes. So they're going to look at current earnings. Projected income should never be used, and I use that term loosely, never, because in certain situations it does apply, and I'll tell you that in just a minute. Use prior earnings if on a new similar job. So if they're in the same industry, making the same in the same industry, same occupation, and the income is going to be similar, that doesn't present a problem. We don't use prior earnings if they're in a new occupation, or an unrelated occupation, because again, unless they've got some sort of contract that shows what they're going to be doing, it's really hard to anticipate what that income is going to be. Now, when we're working with business owners, it says here during the first year starting or purchasing a business, getting coverage can be done, but work with your underwriter. So an example of that is I had a financial planner come to me late last week, and he used to be a partner in a firm, but he left the firm, created his own firm 3 months ago, and is anticipating, based upon projected revenues, of making $100,000 this year. And I thought, oh, this is a tough one. But because LLIS has access to underwriters, I did a pre-screen and sent it to some underwriters, and happy to report that an underwriter said, hey, we'll look at him as a 4A occupation class, and we'll consider the $100,000 of income. Now, I'm only doing a quote, but obviously when we submit it, when he turns in his tax returns, they're going to want to see that that was true, that he was making more money as a partner in a financial planning firm. Okay, so we talked about the financial aspect, we talked about the occupational, we talked about the medical, and we touched on a little bit about the features. Now I'm just going to sort of go into greater detail with these. So we talked about the disability benefit is the monthly amount that they're going to get. The elimination period can be 30, 60, 90, 180, or 365. The 90 is circled because that's LLIS's rule. We tend to look at 90 days because most of the advisors we work with insist that their clients have 90 days of emergency cash available. We touched on the benefit period. Again, we choose age 65 here because that's the most common one. And then with regard to the features that we put on our disability quotes, those are the FIO, or what we call the future increase option, residual, COLA, and catastrophic. And we're going to take a look at these in greater detail on this next slide. So the first one is the future increase option rider. And what this one does is it simply says that there has to be a mechanism on the policy while someone's in their earning years, upward trajectory, to increase their monthly benefit as their income is going up. And that's what the FIO does. It allows them to increase the monthly benefit with no medical underwriting, just financial. The second one is residual. And the purpose of the residual rider is, without that rider, if your client is not deemed totally disabled, they would not be able to collect benefits. In the event that they're deemed partially disabled or residually disabled, where they can work part-time, this allows them to dip into the policy. So they need to have a loss of earnings of 15% or more in order to have the trigger for them to do the residual. The next one is the COLA rider, and what this one says is, in the event that they go out on claim, there has to be a way to increase that monthly benefit, especially if they're going to be off for several years. You don't want, let's say it was a $5,000 monthly benefit, you don't want that to remain stagnant, $5,000, when like now, inflation is at an all-time high. There has to be a way for that monthly benefit to keep up with the cost of groceries, the cost of gas going up, etc. And then the last one is the CAT, meow, my favorite rider. This one simply says that it will pay an additional monthly benefit on top of the base benefit in a catastrophic situation. So if someone loses 2 or more of their ADLs, their activities of daily living, that would be a trigger. If they have a cognitive brain impairment, so dementia, Alzheimer's, stroke out, that would be a trigger. And then the last one is more of a physical trigger, loss of an arm and a leg, or both arms and both legs, or the loss of use of an arm and a leg, or both arms and legs, or the ability to speak, loss of vision out of both eyes, or hearing out of both ears. Any of those would be a trigger to get the additional catastrophic rider. So I wanted to go into greater detail because I get a lot of questions on the increase options. So increase is based upon the Consumer Price Index. So this is a free rider that's put on the policies with most of ours, unless there is some sort of medical condition where the underwriter says, no, don't want to give this to them. And so during the first 6 years that the policy is in force, the client will have an opportunity to have a little incremental monthly benefit increase to just keep up with inflation. And if they turn it down more than 2 times in that 6-year period, then the insurance company is going to take the rider off the plan. The reason they do that is because it's a free rider. You're not paying for this from the get-go. The second future increase option rider is one that's based upon your actual income going up. So it has nothing to do with inflation. This one simply says that every 3 years, we're going to take a look at your income, and we're also going to take a look at any other coverage you have. And if you've had an increase, we're going to tell you how much you're eligible for in order to increase your monthly benefit. And you have to take 50% of what you're eligible for. So if they say, hey, we can increase your monthly benefit by $300, you have to take at least $150, or they're going to take the rider off the plan. Here again, you're not paying for that rider from the get-go, so they know eventually they're going to get some premium out of you. So that's why they work it the way they do, that they don't charge for it because they're going to take the rider off the plan if you don't increase it as your income goes up. And then the last one is a premium-based rider, meaning you're going to pay for this future increase option on the policy, but because you're paying for it, it's got a little bit more flexibility. So it has a dedicated pool of money that you can dip into every year. As your income goes up, you can increase your monthly benefit. If your income doesn't go up, then obviously you're not going to increase it. Or if your income did go up, you don't necessarily have to increase your monthly benefit. You can take it or leave it. That rider stays there. It's not in jeopardy. Now, I wanted to share with you what I consider to be some cool riders, and these are the family care benefit. This one simply says that if your client is working at least 20% fewer hours or has a 20% loss of income because they're taking care of a loved one, they will be able to, after they satisfy the elimination period, get a monthly benefit from their disability policy. This one was really good. I had a story where a woman was an only child. She took time off and used FMLA to take care of her mother, who eventually passed away. And when she heard about this family care benefit, she said, I want this benefit because being an only child, she's going to go through the exact same thing with her father. And she thought this would be a way for her to help offset some of her lost income. The second one is the supplemental health. This one provides a one-time lump sum benefit that's 6 times the monthly benefit if the client has a coronary artery bypass surgery or suffers from cancer or stroke. So I'm putting this up again because we talked about the 3 most common objections, and I want to personally address these in the following slides. So, do I really need it? So if a client has group or individual coverage, they can file a claim. But if they don't have that, what are they going to do if they become disabled and can't work? What are their options? They can access emergency funds. They can file for Social Security. And here again, what did we say earlier in the presentation? The benefit would be about $16,000 a year. It's going to take 3 years to get it. What are they going to do in the interim? And is that going to be sufficient? They can borrow from relatives or friends. They can start a GoFundMe, or their spouse is going to go to work or is going to have to work extra hours. Our second objection is it costs too much. Well, that's not really true. At least I don't think so. Because if you take what it costs to go out to lunch, what it costs for daily coffee, what it costs to go on a date night, which might be $80 to $100 if you got to pay for a babysitter, the cost for a disability policy averages about 1 to 3% of your client's annual income. Now, this is a real sweet worksheet that's on our advisor tools on our website. And whenever you have someone say, I don't need to talk about group, or I don't need to talk about disability, I have group insurance, this is a way for you to break it down and see exactly what they have available to them. And you can say that, you know, it doesn't have the ONOC definition, you don't get to choose the elimination period, you can't take this with you. There's all kinds of different things. Taxation, if your employer's paying for it, it's going to be a taxable benefit. So it's a way for you to introduce the possibility of them buying supplemental insurance. And again, they're going to say, I have group employer paid disability. Well, this is just a quick chart to show that your client's base income is 100%. And we just did 25% taxes, so that means they're down to 75% of their income. If they have a group cap of 60% of their income, most of the insurance companies that we talk to will discount that by about 25%. So the bottom line is, can your client live on 30% or less of their income? I mean, this, I don't know. It's really hard to explain this. So what we did is we took it a step further and we made a graph so you can actually see someone and how it affects their income. So this is Sam. He's 43. He's an account manager. He makes $100,000 and he's got a $35,000 bonus. And he's used to living with that bonus. So his monthly gross income is $11,250. His take-home pay after taxes is $84.38. His group disability pays 60% to $5,000. So because it's taxed, we took it at 25%. So in actuality, that $5,000 is $3,750. Now he'll get $5,000 a month when he's disabled, but he's going to get a 1099 at the end of the year. So we came in and said, well, what if we supplemented your group disability with $4,400 worth of individual tax-free disability insurance? Doesn't that look a lot better? Because you'll be getting $8,180 in the event that you become disabled instead of $3,750. So if you take a look at what his take-home pay was versus what his total disability benefit is going to be, we got him to 97% of his take-home pay. So that's a win-win all the way around. And just so you know it, insurance companies only give 60 to 70% of the client's income. They don't give 100% because there's no incentive for that client to go back to work if they're receiving 100% of their pre-disability earnings. So why is it important to get coverage now? I know what happens. You'll sit down with a client and he'll go, oh, I'll get it in a few years. I'm saving for a mortgage. Oh, I'm getting ready to get married and I got to put money towards that. Or, hey, my in-laws are coming, whatever the case may be. You can talk through it by just saying, look, I'm going to get some quotes run and we're going to compare what it's going to look like by you waiting. So that's the purpose of this slide. It shows Raymond at 35 and Raymond at 45 and the premiums paid to age 65. He got 10 more years of coverage with a small difference in premium, okay? So I think it's really important that you also talk to them about their health, because in 10 years, they may be uninsurable because of a health condition, or if they're insurable, they may not get that great of a policy because of that health condition. So I have some feedback that we get from past webinars, and people want to talk about. As a matter of fact, I've got one today, an email, a woman who is starting her residency program and wants to know what insurance is available to her right here, right now, especially coming up in July when that starts. And that's called the New Professionals Program, which is what we usually try to offer in those situations. And these are the types of occupations. And what it does is it provides a benefit amount, regardless of their income, regardless of where they are in their career path. They get a dedicated amount that the insurance companies say, hey, look, if you're a student, you're going to get this amount. If you're a resident or a fellow, you're going to get this amount. If you're in your first year of practice, this is what you're going to get. You don't really have to qualify financially because it's a dedicated amount. Another great thing is they don't take into consideration any group insurance. So if someone's a resident, they have group insurance through the hospital, they don't take that into consideration. In addition, any other current income that they might have doesn't matter. And then lastly, we have a carrier that will do a graded premium, which is about 43% less than their standard premium, because they realize that these residents, these students, they're not making a lot of money, so they may not be able to afford the level premium. So with the graded premium, while they're still in school, while they're still in training, they have this lower premium. Once they launch into their profession, we have someone here at LLIS that will circle back to them and get them converted from the graded to the level premium. This is a sample of what some of those limits are. So if you have an OBGYN client, they can get, during the first 2 years of practicing, $6,500 to $7,500, pathologist $5,000 to $6,500, an engineer $1,500 to $4,000, pharmacist $2,000 to $4,000. I wanted to present a case study just so you could see. This is a young Corey, age 28. He's a first-year resident, and he's specializing in anesthesia, and his annual salary is $66,000. So we presented him with this. He qualifies for an automatic $5,000 of monthly benefit. We made sure we put that ONOC rider, residual, the FIO, COLA, and oh, by the way, we were able to put a student loan rider, because he's going to have a lot of student loans, in the amount of $2,500 that would cover him if he's disabled and would pay his loan for 15 years. Now, if he gets that loan paid off before the 15 years, we could just remove this rider. And his annual premium was $2,554. And just for the sake of argument, I threw the female rate down there for you, and you can see how much higher that is. So one of the free services that we provide, in addition to that circle back, is a policy review. And the policy review simply says that, we will take a look at a client's policy, give a recommendation if we feel like new quotes are in order to layer over it, whatever the case may be. This just sort of illustrates some of the things that we need in order to provide that policy review. So we talked a lot about what disability can do, and it can replace lost income, but critical illness can go the distance too, and it can go into certain situations where maybe disability is not available. And I wanted to talk about that because critical illness can be used in a lot of different situations. It can be used for the high wage earner who's concerned about the spouse that might be ill and they can't take the time off to take care of them, take care of the house, take care of the kids. It can be used as a layer of coverage for people who've maybe maxed out their disability and perhaps they're concerned about a history of cancer or heart attacks or strokes or something that comes under the heading of critical illness, which I'll talk about in just a minute, or people who aren't eligible for disability, such as long-haul truck drivers, firefighters, people who work in law enforcement, dog trainers. I placed a critical illness policy on a dog trainer who made $120,000 a year. He wasn't eligible for disability. So what can critical illness do for your clients? Well, it's paid directly to the client, regardless of any other health insurance, Medicare, Medicare supplement, long-term care, disability. It's paid as a lump sum. It can be purchased in addition to long-term care or in lieu of it, or if your client has long-term care, it can help pay the bills while they're satisfying the elimination period. It can also pay COBRA premiums. It can pay their mortgage, medical bills. You can do whatever you want with it. It's a lump sum. They can go on vacation with it. They can put their kids through college. There is no restriction as to what you can do with the money, and it's obviously tax-free if you pay the premium with after-tax dollars. It can also pay for specialized care. Maybe you have to go out of state in order to get the treatment. Maybe your health insurance company doesn't cover specific treatment. It can be used for that. It helps you as an advisor standpoint, from your client dipping into withdrawals, their 401k. Maybe, it replaces lost income from that working spouse. And it can also provide income while your client's satisfying the 90-day or 180-day elimination period for their long-term disability policy. So this is a brief slide on some of the features of a disability plan. Hopefully I've got your attention. There are different benefits. The issue ages are 18 to 70, which is great. So you can actually, get someone insured who's retired. It can be a convertible coverage option. So if someone can't afford like a 20 or 30 year, they can purchase a 10-year policy. And after the third year the policy is in force, they can convert it with no underwriting to a higher policy, 15, 20, or 30 year lifetime. The benefit amount can be $5,000 to $500,000. They are guaranteed, renewable, and non-cancelable, just like our disability policies. Simply means that as long as you pay the premium, they have to renew it and keep the policy going for the next year. Non-cancelable means they can't raise the rates. The rates are locked in. There are some return of premium options available. So it just depends upon the carrier and the amount that's available. There are some additional critical illness riders that are available. So if you're concerned about having multiple things, we can make sure that we have some riders put on there that put your mind at ease. And it pays more than once if there's a 6-month separation. So let's say someone has a heart attack and a year later, 6 months later, they have cancer. If they purchased a $100,000 policy, they get $100,000 if they have a heart attack, and 6 months or a year later, if they have cancer, they're going to get another $100,000. It's not a one and done. It will pay multiple times. And we can cover not only the insured, but spouse and children as well. So it gives you an opportunity to put them on as a rider. And sometimes that's the best way to do it. I found that if you put the wife on or the female on and then rider the husband, that's more economical than purchasing separate policies for them. So I want to just touch on this real quick. Benefit amounts. The employed client, so if they have a job and they're working, they can get the $5,000 up to $500,000. If it's someone who is the non-working spouse of like the high wage earner, they can get a maximum of $250,000 or the amount that the spouse that's working is applying for. If your client purchases a policy and if they die of any cause before any benefits were paid, or if a small benefit was paid, their beneficiary that they designate will get all the premiums minus any benefits that were paid. If the client dies of any of the covered illnesses, they will get the maximum benefit. So in certain situations, if a client has had angioplasty, they may not get the full benefit. They're just going to get 25%. But if they've had to have, surgery, then they'll get the full 100% of the benefit. So if there's anything that wasn't fully paid, then the beneficiary will get the remaining benefit amount. And I just wanted to cover some of the medical conditions that critical illness covers, and that's heart attack, which is the most common, heart attack, stroke, cancer. It'll cover all these, and like I said, it'll pay more than once. So if you have, a client who's concerned about these things running in their family and they want to make sure they have another layer of protection, critical illness is a good solution. So at this time, I want to open it up to questions and see if anybody has any questions they'd like to present. So let me just go back and look at these. Okay, so someone asked for an individual policy on a female 25 who has a medical condition that doesn't allow them to conceive, and this is documented. Will they get a lower premium rate? Probably not, because I've asked this, with people who've had a complete hysterectomy. Will they reduce the rates? And the answer has been no, but I would be more than happy to send information up anonymously to our underwriters where we do a pre-screen and see if that's a possibility. What if the client has two sources of income, one regular from physical therapy and two self-employment income from coaching? What do you suggest? Which occupation, larger income? So that's why we ask for all that information, what's their occupation and what's their income, and then the underwriter is going to make a determination as to which one's dominant and how to quote them. Also with that question, are the disability premiums tax deductible outside of the group, like under self-employment income? So if you have your own business and you're going to pay for the insurance policy through your business and deduct it as a business expense, you can do that. But when you collect the when you collect the benefit, it will be taxable to you. So it's kind of a wash in a certain way, but you just need to know that going into it, that it can be taxable. How does vaping factor into medical qualification? Okay, so vaping is not a good thing with regard to electrical cigarettes, but with vaping marijuana, it's just like anything else. They're going to look at how often you're doing it, frequency. What is the legally allowed maximum disability coverage if the client stacks the policies, such as in your example? So insurance companies have what is known as issue and participation limits. And so sometimes someone will come to me and go, wow, my client makes $350,000, but they're only giving them like $25,000 a year. The reason for that is because insurance companies don't believe that just because you make more, you get more. At some point, you need to look at your expenses and see if you can't reduce them. They are not going to allow you to be living the same life that you were prior to your loss of income because you're disabled. So around about $300,000 is where it starts to level off. So if you're in a situation where the client warrants more income, but we can't get it through individual carriers, that's where we go to Lloyd's of London. Well, I go to Lloyd's of London, and I say, I have a situation where, someone's making $3 million, someone's making $2 million, someone's making $750,000, and I need more coverage. We can stack it through an individual disability policy through Lloyd's a lot easier than if we try to do it through individual carriers, because they have limits that we just can't go above. Okay. Can a 60-year-old male get a disability policy? Yes, he can. You're getting close to the limit there, but yes, you can. Can active duty military members qualify for coverage? No, for obvious reasons. They are not eligible. The only way active duty military can qualify is if they're in a position like a doctor, nurse, or someone like that, where they are stateside, so to speak, and they're working like at a base, but they're not going to be going, you know, on duty somewhere, you know, across the world. And obviously that's going to be a greater risk for the insurance company. So we would have to indicate what their current circumstances are. What's the ideal age to buy personal disability policy? Is there an age where it is cost prohibitive to get coverage? So I think the ideal age is obviously if you have an income to insure and you plan on working. So if it's a temporary situation, then no. But to me, I mean, mid-20s, you know, you've got individuals who are going to school and, you know, on an upward trajectory at some point, you know, once they finish their schooling. So the younger you are, the healthier you are, would be the best time to get it. You don't necessarily have to get the best policy there is. If we get you something and we have those future increase options on it, you can always build on that and get a better, bigger policy as your income continues to grow. Can you talk to sleep apnea as a medical issue for underwriting? So with sleep apnea, they're going to look at whether it's moderate, severe. Are you using the CPAP? Because right now CPAPs have a little chip in them, and that chip can prove to the doctors if you're using it nightly or not. And when the underwriter looks at the medical records, they're going to want to see if that's being used. And if it is, then you could be standard. If you're not, then that could present a problem where it could be rated. What about Parkinson's auto decline? Yeah, Parkinson's is not something that they're going to cover. How do you confirm policies don't reduce benefits when SSDI and other disability policies are owned? Okay, that one I'm going to have to answer because I'm not. How do you confirm policies don't reduce benefits when Social Security, disability, and other? Okay, so our individual disability policies, if they get Social Security disability, the benefit doesn't change with our policies. So they can collect from both sources, so to speak. Same with group insurance. If you've got group insurance and you've got an individual policy, you can collect from both of them. That's it for my questions. And so thank you all for tuning in. I think we'll have one next month. We'll talk to you then. Bye.